On Thursday, March 12, 2026, the world's largest asset manager quietly deployed a financial product that fundamentally alters the base layer of the Ethereum network. Some are cheering this as the ultimate validation of decentralized finance, pointing to the hundreds of millions in institutional capital already flowing into the ecosystem. But buried deep inside the SEC prospectus for BlackRock's newly launched iShares staked Ethereum trust is a mechanism designed to siphon wealth away from retail investors. It's a structural toll booth that threatens to permanently centralize the consensus mechanism of the world's largest smart contract platform. My name is Lewis, and you're watching the Coin Bureau. So, is this new yield-generating ETF a necessary bridge for institutional capital? Are we witnessing the quiet corporate takeover of Ethereum's validation layer? Or is this the ultimate Wall Street yield trap? That is exactly what we're going to be covering today. First things first, though, let's look at the staggering numbers BlackRock is currently putting on the board. To understand the sheer gravity of what just launched on the Nasdaq, you have to look at the unprecedented scale of the institutional capital moving through these specific pipelines. On March 11th, BlackRock's iShares Bitcoin Trust, better known as IBIT, pulled in just over $115 million in net inflows. That single product accounted for nearly the entirety of the inflows into the US spot Bitcoin ETF market that day. Since its launch, IBIT has accumulated over $55 billion in assets under management, making it one of the fastest growing financial products in the history of global markets. But BlackRock's ambitions extend far beyond simply holding digital gold in an offline vault. The firm now oversees roughly $130 billion across its crypto-related exchange-traded products, tokenized liquidity funds, and stablecoin reserve management. According to the company's own data, iShares captured an astonishing 95% of all flows into digital asset ETPs in 2025. They're not just participating in the crypto market, but actively monopolizing the institutional access points. And that brings us to the very next day, Thursday, March 12th, when BlackRock officially launched ETHB. This is their first crypto ETF designed to generate actual yield by participating directly in a blockchain's consensus mechanism. The fund launched with roughly $107 million in initial seed assets and immediately saw over $15.5 million in first-day trading volume. Within days, the total assets under management has already swelled to $152.5 million. The mainstream narrative surrounding this launch is clean, simple, and compelling. They will tell you that Wall Street has finally embraced the productive utility of decentralized finance. They will point out that investors can now gain exposure to Ethereum's price action while simultaneously earning a passive dividend from the network's staking rewards. But they are completely missing the structural cost. Let's get a sense of what BlackRock is up to here by looking at the plumbing that sits underneath this specific ETF system. Unlike BlackRock's earlier Ethereum product, ETHA, which simply tracks the spot price of the asset, ETHB does not just hold Ether in a dormant wallet. According to the fund's official SEC prospectus, under normal market conditions, the trust will stake between 70 to 95% of its entire ETH holdings. The remaining 5% to 30% sits in what they call a liquidity sleeve, which is an unstaked buffer designed to handle day-to-day creations, redemptions, and operational expenses. The staked portion generates rewards from the Ethereum network's consensus layer, which are then converted to cash and distributed to shareholders as monthly dividends. On the surface, this sounds like a massive win for retail investors who want yield without the technical headache of running their own validator node. But let's be precise about what is actually happening. The prospectus dictates that investors receive approximately 82% of the gross staking rewards generated by the fund, with network-wide Ethereum staking yields currently running at roughly 3.1% annually. That sounds like a fair deal. But BlackRock and its prime execution agent retain a massive 18% cut of those gross staking rewards. This is not a flat management fee. It's more like a permanent tax on the underlying yield of the protocol, extracted directly by Wall Street before a single cent reaches the investor. And if you dig into the March 9th amendment to the SEC filing, the exact breakdown of this fee reveals a highly coordinated corporate partnership Coinbase, acting as the prime execution agent, receives a 10% base staking fee on all rewards generated. BlackRock retains the remaining 8% as their sponsor staking portion. And this 18% aggregate tax is completely separate from and additive to the fund's standard 0.25% annual sponsor fee. Now, you might be tempted to look at those numbers and think that 18% is just the standard cost of doing business in traditional finance. But when you run the actual yield math, the reality of this product becomes painfully clear. If Ethereum's gross staking yield is approximately 3.1%, and investors receive 82% of that, the gross to investor yield drops to roughly 2.54%. Once you subtract the 0.25% sponsor fee, the net effective yield for an ETHB shareholder lands somewhere between 1.2% and 2.29%, depending on exactly how much of the fund is held back in the unstaked liquidity sleeve. Let those numbers sink in for a moment. As of mid-March 2026, the 10-year US Treasury is yielding 4.28%. The 2-year Treasury is yielding 3.73%. Even a standard FDIC-insured high-yield money market account is paying out around 3.65%. Every single traditional, risk-free government bond on the market currently pays a higher yield than BlackRock's shiny new staking ETF. Investors are taking on the massive price volatility of a digital asset, plus the operational risk of third-party validators, for a yield that does not even clear the baseline risk-free rate of traditional finance. This is the ultimate yield trap. Institutional allocators are not buying this product for the income. They're buying it for the Ethereum price exposure. And Wall Street is using the promise of a diluted yield to quietly capture control of the underlying network's consensus layer. Now, to understand how BlackRock was even legally permitted to pull this off, we briefly need to go back in time. Because when the original spot Ethereum ETF launched in July of 2024, staking was explicitly forbidden by the United States government. At the time, the SEC, led by former chair Gary Gensler, had aggressively instructed all issuers to strip staking components from their final 19B4 filings. The regulatory agency argued that staking services offered by centralized intermediaries could constitute unregistered securities offerings. Firms like BlackRock, Fidelity, and Grayscale were forced to launch their products as sterile, non-yielding trusts. But two massive shifts in the regulatory landscape completely rewrote this rules of engagement. The first was the departure of Gary Gensler, who officially stepped down from the SEC on January 20th, 2025. His replacement, Paul Atkins, immediately launched an initiative dubbed Project Crypto, which explicitly aimed to end the era of regulation by enforcement. The second and far more consequential shift occurred on May 29th, 2025. The SEC's Division of Corporation Finance issued a historic piece of guidance declaring that routine protocol-level staking on public proof-of-stake networks does not constitute an offer or sale of securities. This single memo effectively decriminalized the exact mechanism that Wall Street needed to build yield-generating crypto products. And this regulatory pivot was bolstered by the passage of the Genius Act in July of 2025. While the Genius Act was specifically a federal framework for payment stablecoins, it marked the first comprehensive U.S. legislation on digital assets, sending a massive confidence signal to institutional issuers that the political winds had permanently shifted. Wall Street patiently waited for the regulatory roadblocks to clear, and the moment they did, the race to dominate the yield market began. First came the Solana staking ETFs from Rex Osprey and Bitwise in late 2025. Then, Grayscale activated staking for their legacy Ethereum products. And now, BlackRock has arrived to scale this architecture to the masses. And speaking of staying ahead of massive institutional power plays before they hit the mainstream headlines, this is exactly why you need the Coin Bureau weekly newsletter in your life. That is where we share the latest breaking news and give you the most important market updates and insights. So sign up today using the link down below or by scanning the QR code on the screen. Okay, now, while the aforementioned fee extraction and the regulatory maneuvering are fascinating, they are not actually the real danger here. The true systemic threat posed by ETHB is the rapid, irreversible centralization of the Ethereum base layer. When you buy shares of ETHB, your underlying ETH isn't being staked by a decentralized network of independent node operators. It is being routed through a highly concentrated, heavily regulated corporate pipeline. According to the prospectus, Coinbase serves as the primary Ether custodian and the prime execution agent. While BlackRock has approved a handful of institutional validators like Figment, Galaxy Digital, and Attestant, the sheer scale of the capital flowing through this single ETF structure creates a concerning concentration of power. Let's look at the actual on-chain data. According to Coinbase's own performance reports, the platform already controls roughly 3.84 million staked ETH across 120,000 validators. That represents over 11.4% of all of the staked ETH on the entire network. Now, consider the growth trajectory of BlackRock's products. Their non-staking Ethereum ETF, ETHA, currently holds roughly $6.5 billion in assets. If ETHB captures even a fraction of that demand and reaches just $5 billion in assets under management at a 95% staking ratio, BlackRock would be routing roughly 2.2 million additional ETH into these institutional validator pipelines. If ETHB reaches 10 billion, well, that number jumps to over 4.5 million ETH. Combined with Coinbase's existing market share, this single corporate nexus could quickly approach control of over 20% of the entire Ethereum validation layer. And this is where the technical realities proof-of-stake consensus become, well, genuinely alarming. To affect the liveness of the Ethereum chain and halt finality, an attacker only needs to control 33% of the total staked ETH. To control the actual contents of future blocks, well, they need 51%. If a handful of Wall Street ETFs, all using the exact same custodial and execution infrastructure, cross that 33% threshold, the network's security model fundamentally changes. And we do not have to guess how these regulated entities will behave when pressured by the government. We've already seen it happen. Cast your mind back to August of 2022, when the US Treasury's Office of Foreign Assets Control sanctioned the Tornado Cash smart contracts. Within months, the major institutional relay operators on Ethereum simply stopped processing any transaction associated with those sanctioned addresses. By November 2022, roughly 80% of all blocks produced on the Ethereum network were completely OFAC compliant. 8 out of 10 blocks were actively censoring transactions to comply with a US government mandate. The censorship didn't require a protocol upgrade or a hard fork. It only required a few centralized infrastructure providers to make a legal compliance decision. If Wall Street ends up controlling a massive percentage of the validator set through these new ETF wrappers, that base layer censorship won't just be a temporary crisis. It will become permanent, legally mandated featured among the network. This threat is compounded by the rapid rise of the ERC 3643 tokenization standard that institutions are currently deploying across the ecosystem. This standard, which is being used to tokenize billions of dollars in real-world assets, requires mandatory KYC and AML verification on the smart contract level. It includes built-in functions that allow administrators to freeze wallets and forcefully reverse transfers. If the validators processing the blocks are institutional and the tokens moving across the network are permissioned, well, the decentralized world computer simply becomes a highly efficient database for traditional finance. And the most prominent voices in the crypto space are acutely aware of this danger. The very same week that BlackRock filed the initial paperwork for the staked ETF, Ethereum co-founder Vitalik Buterin publicly warned that a high concentration of ownership on Wall Street could distort the blockchain's governance and create centralized choke points. But Vitalik is not just issuing warnings. He is actively trying to build a countermeasure. On March 9, 2026, just 3 days before ETHB began trading on the Nasdaq, Vitalik announced that the Ethereum Foundation was deploying a new technology called DVT Lite. This is a simplified version of distributed validator technology designed to make it drastically easier for institutions to stake their ETH across multiple independent machines, rather than relying on a single corporate behemoth like Coinbase. The Ethereum Foundation immediately put their money where their mouth is, initiating a program to stake 70,000 ETH from their own treasury using this decentralized open source infrastructure. Vitalik explicitly stated that the idea that running infrastructure must be restricted to a handful of professional core providers is awful and anti-decentralization. And just one day after ETHB launched, the Ethereum Foundation published their new official mandate, actively declaring Ethereum a sanctuary technology. This document explicitly prioritizes censorship resistance, self-sovereignty, and walk-away resistance over short-term commercial features. It's a direct, ideological line drawn in the sand against the exact type of corporate capture that products like ETHB represent. So, the battle lines for the future of Ethereum have officially been drawn. On one side, you have the Ethereum Foundation desperately trying to decentralize the validator set through open source tooling and DVT infrastructure. On the other side, well, you have BlackRock, backed by $130 billion in crypto assets, building a perfectly compliant, highly centralized yield machine that plugs directly into the legacy financial system. So let's wrap this up. The launch of BlackRock's ETHB is undoubtedly a watershed moment for the financialization of digital assets. It proves that the regulatory ice age is over, and it establishes a massive template for future yield-generating products across other proof-of-stake networks. But the cost of this institutional validation is terrifyingly high. By locking up billions of dollars worth of ETH in a single corporate pipeline and extracting 18% tax on the consensus rewards, Wall Street has successfully built a toll booth directly on top of the Ethereum base layer. The yield that they are offering retail investors is a mathematical illusion that doesn't even beat a basic government bond. The true purpose of this product is the accumulation of underlying network power. The institutional adoption phase is officially over. We have rapidly entered the institutional monopolization phase. We traded the cypherpunk ethos for spot ETFs and Wall Street liquidity, and this new product proves that the ultimate price of that liquidity is the centralization of the very network that we sought to protect. The question is no longer whether traditional finance will adopt crypto. The question is whether the decentralized base layer can survive the adoption. But what do you think? Is BlackRock's yield-generating ETF a necessary step for mass adoption? Or is it a catastrophic threat to Ethereum's decentralization? Let me know your thoughts in the comments below. And if you want to understand exactly how Wall Street is building KYC compliance directly into smart contracts, well, you could check out our video on that right over here. And if you want to dive deeper into how institutional custody is reshaping the Bitcoin supply, well, you could check out our video on that right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.